Something important is happening for millions of American seniors in 2026, and a lot of people are getting it completely wrong. You are not getting a $6,000 check in the mail. The government is not sending you a payment. There is no new benefit program depositing money into your bank account. But here is what is happening, and it is actually worth your attention. If you are 65 or older, you may be able to protect $6,000 of your income from federal taxes. That means $6,000 the IRS cannot touch. Not a check, not a payment, a shield, a tax shield built directly into the law for 2026. That difference matters enormously. And by the end of this, you will understand exactly how it works, who qualifies, how much it can save you, and what mistakes to avoid before you file. If this kind of clear and honest U.S. tax and immigration news helps you, please subscribe now. This channel is brand new and your support really helps us reach more families. Now let us get into the details. Every year, the IRS gives taxpayers a choice. You can either add up every single deduction you qualify for, your mortgage interest, your charitable donations, your medical costs, or you can take what is called the standard deduction. The standard deduction is a flat amount the government lets you subtract from your income before it calculates how much tax you owe. For 2026, that standard deduction for a single filer is expected to be around $15,000. For a married couple filing jointly, it is closer to $30,000. These numbers are adjusted slightly each year for inflation. But here is where the senior deduction comes in. On top of that standard deduction, there is an additional deduction just for people who are 65 or older. In 2026, that additional amount is $6,000 for a single filer who is 65 or older. So instead of protecting $15,000 from taxes, a qualifying senior can protect $21,000 from taxes. Think about what that means in real money. If you are in the 22% tax bracket, protecting an extra $6,000 from taxes saves you around $1,300 on your tax bill. That is real money. Not a check arriving in the mail, but money you do not have to pay out of your own pocket when you file. Here is the real problem. Millions of seniors never claim this. Some do not know it exists. Some think it is automatic and do not check. Some confuse it with a different government program. And some file using the wrong status and miss it entirely. Let us make sure that does not happen to you. To qualify for this additional deduction, the rule is simple. You must be 65 years of age or older by December 31st of the tax year. That means if your 65th birthday falls on December 31st, 2026, you still qualify for the 2026 tax year. But if your birthday is January 1st, 2027, you do not qualify for 2026. You would have to wait until the following year. That one day can matter. So check your birth date carefully before assuming you qualify. Now here is where it gets especially important for married couples. If you are married and both you and your spouse are 65 or older, you each get the additional deduction. Both of you. That means instead of $6,000, your household can protect $12,000 of additional income from federal taxes. Before we continue, take 1 second to subscribe. This channel exists only to explain confusing U.S. rules in simple language. Let me give you 2 real examples so this becomes completely clear. First example. Margaret is 68 years old. She is single. She retired 2 years ago. Her only income in 2026 is Social Security and a small pension. Her total income for the year is $32,000. Without the additional senior deduction, she subtracts the standard deduction of roughly $15,000. That leaves $17,000 of taxable income. With the senior deduction, she subtracts $15,000 plus $6,000, a total of $21,000. That leaves only $11,000 of taxable income. The difference in her tax bill could be several $100s. Not a payment she receives. Money she does not have to pay. That is the value of understanding this rule. Second example. Robert and Carol are both retired. Robert is 71, Carol is 67. They file jointly. Their combined income from Social Security, a small IRA withdrawal, and a part-time job Robert still works is $68,000. Without the senior deduction, they subtract the married standard deduction of roughly $30,000. That leaves $38,000 of taxable income. With both of them qualifying, they add $12,000 on top of the standard deduction. Now they are subtracting $42,000 from their income. their taxable income drops to $26,000 instead of $38,000. Depending on their bracket, that difference could save them well over $1,000 in federal taxes for the year. Again, not a check, not a payment, money they keep in their own pocket because they understood the rule and filed correctly. Sounds simple, but there is one catch. This additional deduction only applies when you take the standard deduction. If you itemize your deductions instead, meaning you add up your mortgage interest and medical expenses and other qualifying costs, the calculation works differently. In that case, the additional senior amount is rolled into your itemized total under specific rules. For most seniors, especially those who no longer have a large mortgage or significant itemizable expenses, the standard deduction plus the senior addition is the better path. But your situation may be different. That is why knowing which filing approach works best for you is important. What if you already retired and you are thinking, does any of this apply to me if I only receive Social Security? It depends. Not all Social Security income is taxable. Whether your benefits are taxed at all depends on your total combined income. But if even part of your Social Security is subject to federal tax, then protecting more of that income with this deduction matters. And if you receive pension income, IRA distributions, investment income, or part-time earnings, this deduction can make a meaningful difference. Let us talk about the common mistakes people make, because this is where real money is lost. Mistake number 1, thinking the deduction is automatic. It is not a check being mailed to you. It is not applied by the IRS on your behalf. You or your tax preparer must claim it correctly on your return. If it is missed, you do not get it. Mistake number 2. Confusing this with a government payment program. Every year, news spreads online about checks for seniors and bonus payments. This is not that. This is a provision inside the tax code. It only helps you when you file your tax return. It does not send you money if you do not owe taxes or do not file. Mistake number 3, filing under the wrong status. If you are widowed, divorced, or caring for a dependent, your filing status could change which deductions apply to you and how much they are worth. Filing status affects everything. Make sure yours is correct. Mistake number 4, forgetting the age rule. You must be 65 by December 31st of the tax year, not 64, not 64 and a half, 65. And for married couples, each spouse must individually meet the age requirement to claim their own additional deduction. Mistake number 5, assuming nothing changed from last year. Tax rules are adjusted every year. The amounts shift, the thresholds move. What applied to your 2024 return may be slightly different for your 2026 return. Always verify the current year numbers. Now let us talk about what you should prepare before you file. First, confirm your date of birth is correctly listed on your tax return. It sounds obvious, but errors happen and a wrong birth date can cause your deduction to be rejected. Second, gather your income documents early. Your Social Security statement, your 1099-R for any pension or IRA income, your W-2 if you are still working, and any investment income statements. The more clearly you see your total income picture, the easier it is to confirm whether you are using the right filing approach. Third, check your filing status. If your spouse passed away in 2025 or 2026, there are specific rules about what status you can use. A tax professional or a free IRS assistance program can help you confirm this. Fourth, consider whether standard or itemized deductions serve you better. For most seniors in straightforward situations, the standard deduction plus this additional senior amount is the right path. But if you have high medical expenses or other itemizable costs, run the comparison before assuming. Fifth, and this is important, if your tax situation has changed in the past year, or if this is your first year reaching age 65, do not guess. Use a qualified tax preparer, a CPA, or a free filing assistance program. The IRS offers the VITA program, Volunteer Income Tax Assistance, and the Tax Counseling for the Elderly program, often called TCE. These are free services staffed by trained volunteers specifically to help seniors file correctly. If this video saved you confusion or money, please subscribe so you never miss important U.S. tax and immigration updates like this. There is one more thing worth addressing directly. You may have seen headlines or social media posts calling this a senior bonus or a senior stimulus or a new IRS payment. Those labels are misleading. They make it sound like the government is cutting you a check. It is not. This is a standard feature of the U.S. tax code that has been expanded and adjusted for 2026. The word bonus is informal. The reality is it is a deduction. It reduces the income the IRS taxes you on. That is how it saves you money. Understanding that difference protects you from confusion and from clicking on links that promise checks that are never coming. The seniors who benefit most from this rule are the ones who file correctly, claim what they qualify for, and do not leave money on the table by assuming everything was handled automatically. If you are 65 or older, or if you will turn 65 by the end of 2026, this deduction belongs to you. $6,000 protected from federal taxes. And if you and your spouse are both 65 or older, that is $12,000 of income your household can shield. That is not nothing. That is a real, legal, built-in protection that the law gives you. Claim it. Before you file your 2026 return, make sure this deduction is not missed. Because once a return is filed incorrectly, fixing it later can be slow and stressful. An amended return takes time, it creates paperwork, and in some cases it delays refunds or creates follow-up questions from the IRS that could have been avoided entirely. File once, file correctly, and know what you are entitled to before you sign that return.